Welcome to the 3 in 10 podcast. I'm Scott Slayton, partner and chief strategist at Capital Creek Partners. In each episode, I'll give my brief perspective on 3 things we think market participants need to know this week, and we get it all done in 10 minutes or less. For additional resources and analysis, please visit our website at capitalcreek.com. Here is your starting lineup for the 3 in 10 podcast for Friday, September 12th, 2025, recorded at 3 p.m. Eastern Daylight Time. Number 1, are we setting the stage for another equity bubble? We see evidence. Number 2, technology earnings. A tale of 3 different cities, as Oracle, Synopsys, and Adobe all report. Number 3, University of Michigan consumer sentiment and inflation expectations may have been the most interesting data released this week. So back to number 1, the possibility of another equity bubble. It seems to me that all the proper ingredients are now in place. AI is the new mind-expanding drug that allows investors to dream really big. And today, and this week's earnings reports really reinforce that. Momentum in the market is strong. It seems like technology stocks hit new highs almost every day. And the broad market averages, like the S&P 500, do as well. The Fed is just getting ready to restart its liquidity engine with the first cuts in many months next week. Animal spirits, which seemed to be doused earlier in the springtime, have now come back to the fore. Arguably, financial conditions are already loose, even before the Fed cuts rates next week. Bank deregulation is coming. More credit is going to be available. Private credit is loaded with capital and ready to lend. M&A backlog is building. IPOs are coming to market and performing very well in many cases. Even the dreaded SPAC market is back. The IPOX SPAC index is up 26% year to date and is up a whopping 45% year over year. Now that is speculation. So what are the candidates to play a bubble? Where do we expect a bubble to form? I would say first and foremost the Mag 7 equities. That's where AI is really at the heart and soul of their bull market. And we know that those charts look great. In fact, today, another big-time new high for the Mag 7. Small and mid-cap equities in the U.S. are another possibility candidate for a bubble. They've really lagged the bull market so far and are still way below their highs made several years ago. Emerging markets performing exceptionally well this year, and now I notice that a bull market is underway not only in China, but also in India. And those are the 2 primary engines of emerging markets. If those 2 get going together, look out. And EM may have the very best chart in all of the markets. Stores of value like silver, copper, and gold are also very good candidates as the dollar continues to devalue. The Fed keeps releasing more liquidity into the markets, and we know that fiscal deficits will run very high for as far as the eye can see. Bitcoin is tied to the AI cycle, and Ethereum is tied to the boom in stablecoins. So those are some candidates. Most people should not participate in bubbles, but we also can't stop them from happening. So these are the places where I think they could form, and I think the timing is probably fourth quarter through the first quarter of next year when things could really get heady and we could see some very impulsive performance to the upside for not only those that I just mentioned, but others. Number 2, technology earnings. So we listened to earnings calls from Oracle, Synopsys, and Adobe. And the common thread running through all 3 of these is the massive opportunity being opened up for business, new business, related to artificial intelligence. Oracle dropped a bombshell on us saying they landed 4 major AI cloud contracts and that revenue for their AI cloud-related business would go from $18 billion to $144 billion in 4 years. I'm not sure I've ever seen a ramp of that size for any business. Oracle claims that their data centers are faster and more cost-efficient for training AI models, and there must be some truth to that if they're winning these big contracts. Larry Ellison had some interesting comments on this call. He said that reduced reliance on human labor for computer coding via AI code generation is something that's really helping Oracle. So they're cutting their costs through AI. Ellison also said that demand continues to dramatically exceed supply for cloud infrastructure services. And perhaps the best quote that Ellison had during the call was, "People do not grasp the size of the AI tsunami that is approaching." So I think we have to take Ellison seriously. He is absolutely to be respected, not only because he is the second richest man in the world behind Elon Musk after this week, but only Ellison and Michael Dell have been there for the PC revolution, the internet revolution, and now the AI revolution. So I think he's got experience. He's got pattern recognition. He's seen this before, and he's basically telling us he's never seen anything nearly as big as this in his career. By the way, Michael Dell said exactly the same thing. So is it a bubble sign that Oracle added $240 billion in market cap in one single day? I think so. I think you got to say, my goodness, the entire market cap of Toyota is $240 billion. The entire market cap of Nestle Corp is $250 billion. Oracle added that in one day. So where it took Toyota 100 years to become a $250 billion market cap company, Oracle just reported a quarter and turned that into $240 billion. That's quite staggering. Oracle, Synopsys, and Adobe all spent a lot of airtime on how AI is opening up new opportunities, helping to reduce labor cost, and is expanding margins. So the bottom line of all of these calls is that the AI theme does not appear to be close to peaking. And that is so important for the equity market, because when the rate of change begins to go negative and there's a clear peaking in the rearview mirror, it could get ugly. But for now, I think it's still game on for AI. Now on to our third topic, the University of Michigan consumer and inflation data. So we're interested in consumer sentiment, but really interested in the consumer expectations series that UMichigan releases. It had a huge miss this morning, coming in at 51.8 versus 56.2 estimated by the street, and 56 in the prior month. Consumer expectations have averaged 68 over the last 5 years. So we're way below that now, way below it. And I think it's another sign that the U.S. economy continues to slow. We got inflation data this week. PPI and CPI showed yet again that inflation is solidifying at or around 3%. It just doesn't matter how I slice the data. Over and over, it just comes back to 3%, which is significantly above the 2% target. Consumers now expect inflation over the next 5 to 10 years to be right around 4%. That's a significant uptick from 3.4% in August. Consumers also understand that the Fed has missed its 2% inflation target for 5 consecutive years. Well, of course, their expectations begin to go up if you've missed the estimate to the upside for 5 consecutive years. And by the way, core PCE inflation has averaged 3.3% over the last 5 years. Consumers also understand that the U.S. fiscal situation continues to deteriorate, and there are other tailwinds to inflation over the next 5 years. Things like deglobalization, things like energy transition, demographics, fiscal spending. All of these are tailwinds for inflation. They also understand that the Fed is about to cut rates with inflation well above target. Now, market-based inflation expectations look better. They're at around 2.5% looking out over the next 5 to 10 years. We think the risk is to the upside, though. as the Fed continues to miss its mandate. Wrapping this all up, the concluding thought is that AI-driven productivity gains are key to the future for earnings, for inflation, for the bond market, for the equity market. Let's sincerely hope that they come through because a whole lot is riding on them. So do the work, endure the pain of gain, and have investment courage.
The information in this podcast is educational and general in nature and does not take into consideration your personal circumstances. Therefore, it is not intended to be a substitute for specific, individualized financial, legal, or tax advice. To determine which strategy or investment may be suitable for you, consult the appropriate qualified professional before making any final decision.